Indiacharts, the truth about the markets.
Indiacharts publishes Nifty daily video updates, the weekly Elliott Wave outlook, and the long-short report covering all asset classes.
Hi everyone, this is the 20th of April 2023. We are at the last day of the pre-expiry week, that is tomorrow. And the reason I call it pre-expiry week is that 1 week before expiration, stock options start going into settlement, which means that they have to be settled by delivery next week, and for that most brokers start asking for margin. So the entire volume or liquidity in the current month stock options starts to dry up starting from tomorrow, and then that leads to sort of a shifting, and then we start seeing some liquidity built up in the next month's stock options again. So this is an interesting phase because it leads to people squaring up trades in the current week and then trying to move it ahead, or if they're not moving ahead, the squaring up itself causes some kind of volatility in the market based on the positioning that they have. And so you always see the markets consolidate, pull back, or even bounce back up if it is a bearish trend. You see all those wild swings during this week, and that sort of we've seen at least 2-3 days of fall, though this week selling actually started with Infosys results on Monday, and after that prices have been in that range. You've got 3 days of inside bars which are all inside the big candle that we made in Monday. We haven't really broken out of that. If we actually look at the very, very short term chart, we end up looking at what looks like a triangle pattern, something which is a consolidation before which the trend can break out in either direction. And that's going to really make it interesting for the next couple of days because it sets the tone. And because we fell on Monday and then formed a triangle, there's a case that short term, maybe that direction can actually be down. You do have the RMI in sell mode on Indian equities, US equities, and so there's a case. The interesting thing though, which I'll come to on US equities, is the entire setup and positioning. Now, before we go there, we are in the earnings season, and that is, of course, going to play on everyone's mind and every day's moves. Well, we started with a bad tech earnings on Monday. We have HCL tech numbers tomorrow, and a lot of the earnings numbers in the fourth quarter, that is the final quarter of the year, actually spread out over a longer period of time because the deadlines allowed are longer. So instead of all the earnings being announced within a month, it actually stretches all the way into May, and that sort of prolongs the entire impact on markets from earnings. But there's a nice rule that whenever there are results, ideally don't trade on that day or don't have a position in that particular stock because it can give you wild swings irrespective of whether you're right on the earnings number. It can be a good number and prices can sell off simply because of profit booking. It can be a bad number and still result in a big sell-off, or it can be discounted and therefore after the bad news prices actually rebound and start going up. So it's not typically advisable to have positions around a result date. Very rarely it's been beneficial to me, but on most occasions it's actually been more risk and simply leads to unexpected moves, loss, and unnecessary tension. So that is best not done. And as we start talking about the month end, because next month is expiry, I really wonder. Today was the weekly expiration, and weekly expiries are a tricky spot because a lot of people have started to trade this. In fact, US is even doing daily expiries, and that has led to huge open interest in the option space because with everybody buying lottery tickets. Actually call them lottery tickets. You might have seen my Twitter thread on that today, because you're buying something for $10 hoping it becomes 40. My real problem with that is, fine, if you have really no money and you're really looking for a lottery ticket, you're willing to lose everything you have in your pocket. It's like you go spend $10 on a lottery ticket, but here you're in the stock market, you might be spending a lot more than that, maybe 10,000 or 50,000, who knows what. And we don't think that it's a lot of money. That's the unfortunate part of the story. But if you really came to the options market with the idea that you wanted to, build sizable gains that you can then deploy into investing, which is how, if you listen to a lot of the stories of people who came, they traded, they made money, then they invested, they created wealth. That's been the story for a lot of people. Not everybody is a startup investor only from day one. You can even allocate that to people like Rakesh Jhunjhunwala, who's become famous as an investor, has always had a trading background. You have George Soros, and his big trades made him famous, but eventually he's been an investor in the market. So, but then there are those big trades. Now you think of George Soros, he took a multi-billion-dollar bet. You think that was possible by buying weekly options? You think he bought weekly options on the British pound in the early 1990s, where he made almost $1 billion? I think that's the amount, if I'm not wrong. Probably not. So the typical bet in these situations has been slightly long dated, but being right about something. So being right is more important than really the timeline, which is why do you want to deal with time? Why do you want to fight with time? I call time the enemy. I say time is your enemy, because you can be right. And I'm sure there's been the experience of so many investors and traders when they think like, this is what I think the stock will play out, and then they give up, and then it actually does what they thought, and they said, oh God, I lost patience. That's essentially time working against you. And in the options market, that's exactly the same thing. You're betting on something will happen. You expect it to happen within 5 days because it's going to expire in 5 days. But it might happen on the 6th or 7th day. And then what? The market won't pay you back. So the way I deal with it, I say become a good analyst. Learn to read the charts, because that would definitely help. Options are a shorter term instrument. You need to be able to gauge the trend and sentiment. And if you're able to do that well enough, you're able to gauge the movements over a couple of days, weeks, 1 to 2 week kind of moves, or at least 4 to 5 day moves. Those are sufficient for options traders. If you're able to judge those and get on the right side of that trade and have a good risk reward, it doesn't mean trades don't go wrong. So you're at a point where you can minimize risk, and in any case, charts, you're minimizing risk. And when you're buying an option, you're anyway minimizing risk, because you're only paying a premium. You're not really paying M2M. You're not paying the margin for owning that underlying stock like you would in the futures market. So you're taking that part of the risk, which is what I like, because then you can ensure how much you're risking. You can buy time. And then if you're right, you can actually get paid, and you can sleep well at night, because even if there's a nuclear blast, nothing can happen to you. So it's a discussion we're going to be having on the mentorship session coming Sunday. We're going to be talking about how to buy the right strikes, which options to deal with, how to create an options book. That's going to be the discussion part of it. Of course, we're also going to be discussing long-term positioning of portfolios, something we started talking about last weekend as well. But this is the important topic. So if you're really, looking at options, I think of it, why would I not want to create a book where I can deploy larger sums of money? I can run that book over a longer period of time. And for that, you need a scalable strategy which runs on a view, involves some amount of time. So you're not fighting time. And if you get on the right side of that view, you get paid back, And even if you're on the right side a little bit, you at least get your capital back, and then you're able to take the next bet. So you reduce risk significantly by playing it in this way. And even if you're right, 6 out of 10 times, 7 out of 10 times, every time you're right, if you're able to make significant gains, the few times you're wrong, you just need to minimize and quickly move out of those trades that are not working. And that's sort of good enough. So that way you can actually build capital, and every time you're making significant amounts on the winning trades, you can start investing. That's really a good way to work around the idea of building a portfolio if you're starting out small. So if you're starting out small, doesn't mean you come and buy lottery tickets on weekly options. That's my main point that I'm trying to make. Now, options have also become a very, very interesting instrument, because they have gotten a lot of attention from the crowds. Part of this attention has come because after 2008-9, the open interest, or you can say the market share of the options market, has really grown significantly compared to the total open interest. So prior to 2008, since the inception of derivatives in India, 2002 to 2008, 70 to 80%, I think 75 was the peak. 75% of the options, of the total open interest in the derivatives market was actually futures, and it was not options. So what that meant is people actually got paid when there was a directional market. So you got big moves. We had even within a bull market, 2006, you got a 2-month 30% sell-off in the market suddenly, because a lot of positions got built up in futures, and the unwinding caused the crash, and then again the upward trend started and the bull market went on. So that was like normal to get wild swings and crazy moves in the option side and get big paybacks. But that sort of slowed down after 2008-9. And as the options market actually grew, now it initially went to 50-60%. Okay, and then it's slowly been advancing from there. And post COVID, it's gone to 85%. Now this is massive. So you have only 15% of the total derivatives market now in the futures side, and rest of it is all options. And so in the option side, now payback has become very, very controlled. You don't get those wild moves except randomly, maybe in somewhere and something. But take the Nifty, you don't really get those 30% in 2 months. Hasn't happened like in more than a decade or more, maybe almost 2 decades since we last saw something like that. And so massive moves are done because now that not just the buyers but the writers are also on the option side, there's actually an interest. Like I said, in the future side, you could make money by direction. So you got direction. Now that money is being made through lack of direction, which means the sellers don't want volatility, the buyers want some volatility. What you end up getting is something in between. So a much lesser volatile market, unless there's a black swan event, and then you need to work around that. So what used to happen in the older, more volatile times is writers used to get killed if you got, that kind of a move, 20%, 30% in 1-2 months. And especially if that meant that, you get 2-3 days of consecutive gap downs, then an entire options book could get wiped out. I've seen that in front of my eyes in 2006, that crash. Entire options book getting wiped out. So entire year of gains or 2 years of gains can go within that 1 month because you're really trying to hedge your delta and hedge your positioning, which you're supposed to based on a systematic method. But the sheer scale of move and the amount of hedging costs you so much that the losses are paramount. Now, the funny thing is, one thing that I found from that experience and many other products, not just one, I've seen many other products after that, which could actually be claimed as successful because the product owners would say, well, this is a strategy that would have worked if I continued to execute it as it was supposed to be executed, except that when there was a drawdown, maybe the drawdown was a little bigger than we thought. Everybody gets scared and then they close the strategy. It's happened with me, it's happened with others. And that really takes you back to how do people perceive a particular strategy or a particular view. I mean, people come with the expectation that it's supposed to work 100% of the time. Even though if I tell you in advance that, see, here's a product, it's going to develop you, give you 30-35% per annum compounded, the risk is that you get a 20% drawdown. Investors will say, great, that sounds good, I'm very happy, here's my money. But the thing that they don't anticipate is, what if they give you the money and you hit a 20% drawdown at the start? Now they can't handle it. They were not supposed to face a 20% drawdown, even though they were told that it can happen. Ideally, they probably imagined in their mind that prices would move in their favor. And then after that, if there was a drawdown, they wouldn't really lose too much. But unfortunately, if it happens on day one, then it's a problem. And if the drawdown becomes slightly bigger, then most probably the owners of the product, or rather the people who are allowing the owners of the product to run the product, would get worried and shut it down, or the clients would force it to get shut down. And then the money would be moved into a less riskier strategy to recover losses which are already massive, which completely makes no sense. It's bizarre to me because I have seen that, if strategies are workable even after a 30% drawdown. I know someone who had a strategy in 2009, which he said, see, well, if we just contained and continued with the strategy even after that broad drawdown, it would have eventually just recovered it all. So the main point is, were you willing to hold on and stick to your strategy? And that's where a lot of things get lost, because imagine if you have a large drawdown in your strategy, the strategy, which is a high risk, high reward profile, can only earn it back for you when the high reward comes. So if you shift a high risk, high reward profile strategy to a low risk profile strategy after the drawdown, you're simply going to make the duration of returns much longer to get your capital back. So something which is minus 30 will not come back to zero over 1 year where you lost it, but probably take 7-8 years just to regain it, which is a big misuse of capital. Now, of course, that doesn't mean you go back to a bad strategy. Okay, so it can mean that you had a mid-cap portfolio that draws down 50%, and then you transfer it to an index fund, the one I was running in the PMS at Sharekhan, and some funds were transferred that way. And then the people who moved it there from a fundamental to a long short strategy, which would slowly earn you back because volatility had actually come down. So compared to our previous returns, we were only giving maybe 5-6% at one point of time, 10-11 at some point of time. It wouldn't be good enough to bring back a 50% drawdown from buying mid-cap stocks. So completely strategies can be mismatched. There can be a mismatch between one strategy and the next. And that's again not a good way to try and earn it back, you have to seriously think about being in the same strategy, but in a workable way. Of course, if it is a failed strategy completely, I mean, you don't want to be long-term capital management. That was not the point that I meant by saying that you need to be in something, but you have to stick to something. So for example, nobody's ever always right. You can be right on the markets, seven out of 10 times if you're really good, 6 out of 10 times on average. There are day traders who work at less than 50%. And even if I'm right 70 to 80% of the time on the market, my actual trades, because that involves a little more than just having a view, it means execution, getting in, getting out, managing risk. Then you have actually looked at closed trades in the process of doing all that, and you'll find that less than 50% of the trades are actually the winning trades. Rest of it is all trade management. And therefore, you'll actually feel, oh, well, the strike rate is not even 50%, which is not the case, but because the opinions might be right more than wrong. And so that's how it works. Even when your significant gains end up happening in those few seriously good trades, and the rest of it is managing risk and trying to get a sense of markets by taking different positions. And this is a very, very involving process. And if you want to get to that place, you really have to immerse yourself in understanding how markets work, how to trade. And it's something you have to do for yourself. You just can't depend on somebody else doing it for you or spoon feeding it to you. Because if there's somebody who knows how to do it, last thing you should be expecting is that he's going to spoon feed it to you. So that's the approach that I have taken, at least at Indiacharts. We don't spoon feed. We share information. We share data. I go wrong, and I think I face the same problem. If I go wrong, there are always people who will quit and leave, which is something that we can do nothing about, because most people are looking for spoon feeding, but not willing to really learn the process and go through with it, understanding that this is how it's going to happen. There are going to be drawdowns. There are going to be periods where suddenly some things don't work. In fact, most people simply wait. I mean, in products that I have run that were actually at a time successful for 8 to 9 months, you'd find that people would actually not be listening to you or following what you were saying for a large part of that period. So we actually were running something known as quarter delta. I'm saying one of the first products we ran on that way. My first experience of something like this. We ran it for 11 months consecutively. Every month showed a profit, and then people actually believed this works in the 12th month, exactly the month when we were prepared to go. I mean, we were not prepared. You never know. You don't know when you're going to go wrong. If you knew that, you would be God. So you only know that you have a strategy that will work most of the time. It always has the odds of not working once here or once there. But if in exactly the month where you're going to be wrong and everybody decides to follow it up, then that can be an unfortunate experience. And that's what happens so many times. And so I've given you 2 examples. One of people pulling back exactly. I mean, going in for something exactly when it can go wrong. Second, people pulling back from a possible strategy that could win, but because it was a drawdown, into another strategy that is, less aggressive, and then spending a long time trying to recover it. That can also be, awfully wrong. Or you could actually, end up executing something exactly as it is to be, and having the patience to see it actually play out over a period of time. It's a tough thing, but I don't know if there's any other way to really take it through. So things have changed definitely in terms of the way volatility is behaved in this market, when you had all the open interest in futures, and now that you have all the open interest in options, and you have to deal with it accordingly. And then with the stock options going into delivery based settlement, you have this additional volatility and behavior, liquidity drying up in current month, shifting to and then the next month building up. So there's this gap period where nothing really happens in the options market, and but many times a lot of big swings in the market end up happening in these gap periods. So very, very tricky, but you have to work your way around it. This is where we are in the market. We are at a time where prices are pulling back. We've had a lot of data come in over the last couple of weeks. In fact, last week I think you had most of the inflation data come out, and a lot of it was showing weakening trends, which was taken positively by the dollar by actually declining, and bond yields pulling back. But technically both of them had divergences, so which is where the bond yields are actually jumping back higher over the last few days after the initial decline, and same with the dollar. Now that is setting up for what we are seeing is a short-term correction, but the data itself was supportive. CPI was dropping. In fact, WPI in India had hit as high as 15.8%. Remember, WPI used to be the main inflation gauge before we started to look at CPI, and It was the main means of actually deciding interest rate policy. Then it was changed to CPI. Now, at least we are still stuck with CPI. US talks even more about core than we do. Now, the funny thing is, as you move towards core, you actually stop looking at what is most important to the public at large. I mean, the first main reason to actually look at CPI, C means consumer, is to know what affects the consumer. I think food and energy affects the consumer more than anything, and then we say, no, let's exclude food and consumer, let's look at core, which actually doesn't include food and energy, which is the most important to the public at large. And so if core is not really going anywhere and if it's low, we are all good to go. But that can be a pain point, especially in an emerging market. So we are still fortunately looking at CPI in India, and CPI trends are down. Even food inflation has seen a significant drop down in India. In US, you still have core sticking around for other reasons, what they're calling non-core services inflation. And even that data, if I go by the lead lags of data in the US, should eventually cool off. So all that is happening. But when I listen, and so this is where the catch is coming in, we're also heading into what is known as the US debt ceiling. Now, I don't understand so much attention is paid to something which is a self-created event. I mean, what is a debt ceiling? A debt ceiling is a ceiling that this is the maximum we are going to borrow as far as we are concerned, and this is a limit set by the parliament, which only the parliament can raise, and surely every government that's in power is going to raise it because they need to borrow more. So what is the point of having such a ceiling that you have raised maybe 24 times in 20 years, but every time it comes up for discussion, it is used to create some chaos in markets as to, oh, well, this time we are not going to raise the debt ceiling. Like, yes, this time we are going to ensure that the US defaults on the whole world, and that is being said by an American politician. Is that really possible? I mean, unless somebody would be in a suicide mode wanting to destroy his own country, he wouldn't take actions in that direction, which means it's just a political game. You gain some brownie points by talking about it, screaming about it, pushing it to the borderline, till the last day, and then giving in and saying, fine, this is what we all agree to, and now it can go ahead. And that's what they've done time and again. So I don't know if this time will be any different. Surely the time it's different, it's a global black swan, because it'll be somebody who wants to bring everything down that would do it, but most probably not. So let's at least forget about that part. But surely it will create a mild pressure point as we get closer to June, until that date is really forwarded. But it's possible the market pays not that much attention to it. What everybody is paying attention to, though, if I listen to every hedge fund manager and every interview, whether it's on YouTube or podcasts, who are speaking, and they continue to say the same thing. It's like almost a consensus trade coming up across from the hedge fund community that US earnings are going to continue to weaken. The GDP growth that we saw bump up because of some first quarter reflation will very quickly die down, and you're going to see a big drawdown in the economy. Now, a lot of economic data is already at the weakest level. Usually when you get to the weakest level in economic data, the market has reached its lowest point. In addition to that, if we also look at sentiment, when sentiment also reaches an extreme, you have reached the lowest point. And third, but not last, there's something known as the liquidity cycle. There's an interesting chart by Michael Howe, I think, of Cross-Border Capital, been there in different interviews, and he actually shows an indicator of the liquidity cycle, and the liquidity cycle is also at the bottom. So you have economic data at the bottom, you have liquidity cycle at the bottom, you have the AII bull-bear ratio at a multi-year low, probably lower than 2009, and you have sentiment at the same extreme. You have short positioning, the highest short since probably 2011 in the CFTC futures data on the S&P 500. And all of this put together makes you feel that this is a sentiment extreme, and everybody's talking about a recession. So is all this bearishness going to get paid, or is it just extreme bearishness that will get wiped out? Very, very tough call to take. The fact though is, yes, we are likely to see a weak US earnings season. It's already happening. And so maybe there's definitely short-term risk. I'm not ruling that out. But will a short-term risk result into a medium to longer-term calamity? And the sentiment doesn't really add up to that front. So we're going to have to take this as on a trade-to-trade basis, because sentiment doesn't add up. And sentiment is an important factor when we actually study Elliott wave analysis, try to gauge what is the wave structure, wave count, because at each of the movements in the waves, when they reach a completion of a particular structure, you do see extremes in sentiment or divergences in sentiment which are in place. I think in the Indian market, probably the only indicator which is not cooled off a bit is the premiums that we see in in the Nifty futures. They're still rolling over at more than 100 points from current month to next month. That number should have come off a lot. And despite a 3-month decline from December to January, we actually haven't seen that number cool off. And I think that remains one of the last things which didn't happen, even though in March we did see one of the highest short positions built up by FIs, which has resulted in the most recent rally, apart from whatever buying that has come in from mutual funds. And even FIs did buy some amount into this rally. We've in fact got a 13-day consecutive move in the BSE small cap index as small stocks started to rebound. And so that's another winning streak. The Nifty mid small cap index did close down yesterday, pausing on that streak, but the small cap on the BSE continued to move higher. So I think we still haven't got that short-term reversal in the mid and small cap rally, which is now on for 13 days and going. But somewhere, like I said, when you get this long run, it does pause and then you get some consolidation. And if the global markets have these reasons to pull back, we want to really judge to what extent can you get a pullback. Will it be small? Will it be big? And frankly, I don't know, but I think the right approach would be let the market tell us. So be on the side of the market, let it tell us. But in the big picture, because we are at such extremes and we are more than a year into this so-called bear market, and some people even debated yesterday in a spaces whether you can call this a bear market or not, or whether another 1,000-point fall is a crash. And these things are so hard to describe because 1,000 points may not sound like much, but yes, from the top, if you're down 20%, it's a bear market. So if you add 1,000 points twice, you can call them non-crashes resulting in a bear market, which is very, very weird. So definitions can be peculiar. You can have stocks that have fallen a lot and then claim that, well, stocks are already at 12,000 levels, so is the Nifty at 12,000. But there are enough stocks that are also at new all-time highs that have trended higher. PSU stocks have done well. You have, the defense stocks that did really well. And so can you really put everything in one basket? You had the auto sector hit new highs by mid of the year into June and July. And so many differential varying trends. But on the other side, you had a very, very weak IT sector. So is the Nifty really giving us the entire picture? I think coming back to the main point, there are risks. We watch those short-term risks, but in the big picture, I'm not able to take that bet outright on something big and massive happening because sentiment and positioning does not really add up. So that's, I think, in a nutshell, my thought. But I'm really surprised by the type of negativity, at least in US markets. I think everybody's talking about the same thing. Recession is coming, earnings will slow down, a credit contraction will drive this move lower, and it's going to hurt. And can that really happen with everybody talking about the same thing, overlooking the idea that the liquidity cycle is at the bottom, and that means liquidity could expand. We are seeing global liquidity expand. We have seen the Fed step in at least twice in the last 6 months with expanding liquidity for different reasons. And what will stop them from doing a lot more of that moment some of these economic and macro data points that they are watching start to cool off the way they are thinking, or even more than what they are thinking, and then they would quickly move in the opposite direction? Would you still get a massive rub-off on equity prices? Very, very tricky. And it's going to be hard to take that trade aggressively. You'll have to take it using proper position sizing rules, and that's the only way you're going to be able to trade it right. So trade it right, learn to get it right. This is what we are discussing. Position sizing and trade management is the final level that we discuss in the mentorship programs, and that's what we are doing right now, Sunday to Sunday. And I'll leave you with these thoughts on the markets and catch you all next time. Thank you.
Nothing in this podcast is investment advice. Views on financial markets are in good faith to expand your understanding of how markets work. Please consult a registered financial advisor for the same.
And yes, please share this podcast with everyone you think can benefit from this knowledge.